Good evening, everybody, and lovely to be here with you. The reason for putting all the geopolitical stuff up front, all these gloomy, depressing pictures, is just to remind everybody before we get on to economics and investments and global growth. Okay, that's better, right? No? Yes, good. I've never mastered technology, as you know. So I wanted to just get the geopolitical horrors of this year out up front. For those of you who don't know the Pink Floyd and their rather gloomy music of 10, 20 years ago, I guess it was, they've just launched an album for the first time in 20 years. One of their great songs was "The Lunatics are on the Wall," so that's why I was playing that. We forget just how horrific this year has been. I'm not going to speak too much about any of this stuff in terms of how it affects economics, other than Middle East and ISIS and the current US policy or lack of it, because that will affect us. And of course Putin and the Ukraine, because if you remember, that did take a hit to the European markets earlier in the year. We will still have geopolitical volatility, and as investors, we're still going to have to factor that in. So other than that, we'll get straight into economics. I need to entertain you and inform you and educate you in the next hour. We will be going through some fairly heavy economics, made fun as I always try to, and simple in the areas of growth. The big issue now that all economists are worrying about is what has happened to global growth. Are we ever going to grow again? Are we onto a new normal? Is the best already behind us? What's happened in Europe? Is China now slowing down? Is this a fundamental secular thing, or is this just a temporary blip? Okay, so we will spend quite a bit of time on growth and M cycles and stuff like that. We won't spend as much time on the politics, because politics has been calmer this year, which is good. Before I've had to spend quite a bit of time talking about economic policy makers largely messing up the global economy and wrecking your stock market returns. Fortunately, this year that has happened less. The Republicans didn't shut down the US government this year. They may well shut it down next year, so we'll talk about that. But by and large, we'll focus on the economics. And the other major topic and big issue I want to talk about this year is oil. For those of you who haven't been in a cave, as you know, oil prices have just dropped off a cliff, declined by 30% in the space of merely 4 months. There is good news and bad news for the global economy, for growth, for investments in that. So we're going to really focus on oil. The OPEC meeting, the key meeting, one of the biggest events of the year, is tomorrow in Vienna. And either equities will shoot up and oil will crash down, for those of you who are holding positions, that's how you should have positioned yourself, or it will be relatively neutral. So we'll spend a bit of time on oil. I'm heartened to see some of you in the audience with a moustache. As you know, it's Movember, to draw attention to male cancer, prostate cancer, testicular cancer, all these nasty things. More men actually have bits of their body parts chopped off than women do, and more men die from these cancers than women do from breast cancer, so it's to draw attention to that. I know I don't look as good as some of the gentlemen sporting these dashing things. I've moved from looking like Rowan Atkinson and Mr. Bean to looking like Basil Fawlty. Since I'm now in the hotel business, I think that's quite suitable. I have my Manuel moments every day these days when I'm not being an economist. I'm not going to do the Ministry of Silly Walks, don't worry, but my Basil Fawlty moment, for those of you who approve, I might keep it for a little bit longer than the next couple of days, before the end of November. So that's the moustache. Let me just remind everybody, I had forgotten, this was the 10th year of economic briefings. And this is where we started, and believe it or not, I didn't realise Bridget wasn't even at the chamber. We had a different logo, we have a different Bridget, but I can't even remember who it was, which shows the impact of Bridget. In the British Chamber of Commerce in Singapore, they don't use a normal Christian calendar. There is BB before Bridget and AB after Bridget. And the date of this briefing was, 2BB, right? So, but what was interesting then, so it's been 10 years we've been going strong. What was interesting then was, the music was a bit better than today. But the topics that I was talking about, you can move on the next slide, it was oil was up front there, but it was all about the debt and the debt burden on the economy. If you go to the next page, just to remind you, there were quite a few economists. I wasn't the only one considered a gloomy economist that was saying, look, the whole world order of supernormal growth that we've been enjoying in the mid-2000s, it's all going to tumble down if you don't do something. Unsustainable levels of debt, both public and private. So warnings were there. At the British Chamber, the warnings were there early. I went to zero position in equities in 2006. Those of you who were there may remember that. Loaded up on Singapore real estate. And as you know, I do extreme asset allocation models that your IFAs and investment advisors won't agree with, but I've always said that that's the best way to get better returns of, zero or all or nothing. And then, of course, you remember what happened in 2008. So, we were early on the news, and we're now back to a position where, we're 5 years on from the start of the recovery of the crisis, and we're still finding weak growth, struggling economies around the world. The only place that is really doing well, in fact, we're flying on one engine at the moment, is America. So, hence Captain America, the title. Sadly for us, the EU that we have to talk about and whether it's going to pick up or not is not performing at all, and we are going to be wholly dependent next year. Most of what you'll be looking at as investors, as investment advisors, will be US growth. Let's step into the politics, quickly get rid of that because there's not too much to talk about there, and go straight into the economics. So that's what we'll be covering. The usual set of topics where after the economics I will finish with investment. I'll look at how we did, how our investment recommendations last year did, what I'm tipping to invest in for the medium term. I always do this for the medium term because it's economics, for the next 1, 2, 3 years. Let me just start by seeing how the markets did. And as you know, markets often don't necessarily follow economics, and in fact, for those of you who remember briefings a couple of years ago, there was a point where the markets completely detached from economic fundamentals and followed politics and economic policy and the things going on in Europe and the potential euro crisis and the breakup of the entire world economic order. You'll be pleased to know that this year, like last year, more so this year, markets started following economics. And if you see how the S&P has done versus the performance of the EU, you find that the slow but steady recovery growth, very easy money, not much fiscal stimulus, but quantitative easing support, continued light deleveraging by households, but the start in recovery of real earnings and wage growth, and the recovery in employment, and that's always a key metric to look at, has correctly propelled the US onwards and upwards. And stock market investors who, not listening to me, continue to pile into the green shoot recovery school of thought on the EU, thinking that at some point they will actually join the US, got badly burnt when they finally saw German austerity, orthodoxy wreaking its damage, even on Germany itself, as we warned, and the EU just plummeted. So, exactly what you would expect. Notice that Singapore is important because I use that as my canary in the coal mine. It is a call option on global trade and overall global growth. If Singapore is not really going anywhere, it means the big picture of the overall growth of the world economy is not going anywhere. And unfortunately, I don't see much hope on that changing for Singapore, for the Singapore stock market. There were a few good things in politics this year, and most of them were in large emerging markets that I'm rather fond of, for those of you who listen to me often. I gave the Golden Turkey Award that we give every year to the outgoing administration of Congress. So it's good to know that they were kicked out. They deserve to be kicked out, having lost the momentum in India, having gone absolutely nowhere in any of the structural reforms they needed, and growth in India was plateauing and in fact declining. Modi deserved to win. Of course, it's a honeymoon period. Of course, everybody is putting huge expectations of genuine reform, genuine investment in infrastructure, genuine structural reform, genuine liberalization, all the things that we know India needs. But I'm a strong supporter. I'm betting on this personally, and I think India will do well. And it's good to see the back of Congress. Remember, India drives the whole of that South Asian cluster. We'll talk a bit more about that in a minute. Those of you who jumped into the Nifty straight after the election would have done very well, about 25%. On Indonesia, one of my other favourite large emerging market economies. As you know, I'm a consumption economist. I like consumer-based growth. I like the urbanizing new Asian middle-class story. That's what I personally invest in. And Indonesia, although not as good a story as South Asia, I think, still has some fiscal deficit issues, still has a lot of structural issues and reform needed in the economy. But the fact is that it's an interesting pattern. Both of these guys are fresh, they're new, they're vernacular speaking, they've come up not from established political dynasties or the military or the existing establishment. The same thing's happened in Sri Lanka. They are there to hopefully make a difference. And both of them are consumer-based economies I rather like. Not without issues, not without risks when you get US tightening in their currencies, because both of them have deficits, but I think they'll play strong. On Iran, I am as dovish politically as I am an economist. I'm a great believer in engagement and bringing Iran into the global economic family. Never forget, these guys are not Arabs. These guys are different people. They're very intelligent, they're very smart. They do want to be a balance of power between the large Arab power systems and Saudi Arabia in particular. They do have oil, they do want to get it on the markets, they do need to balance their budgets, they do have a growing urban middle class, they do want flat screen TVs and Toyota Corollas and all those other things, and not go around causing trouble. So I do have high hopes for the talks with the US. As you know, they've been delayed. Obama wants this to be one of his legacies. I think that will do a lot to calm things down in the Middle East, and our interest in investment is, of course, they're sitting on the potential production of about 3 million barrels per day. They've only got about half of that flowing. They can't access the world markets officially because of sanctions, but they do so unofficially. If they switch that back on, that will be good for the oil markets in terms of additional supply and potentially pushing prices down. The last good side of politics, the Scottish referendum. Everything that could have been said on this has been said, so I'm not going to say too much, other than the economics of Alex Salmond's position, as you know, sucked. Right? It was never going to work. It relied on them getting a fabulous divorce settlement, and Britain wouldn't have given it, of around 95% of North Sea oil revenues, and living a series of projections on continued flow from the North Sea. This was before the oil price collapsed, by the way. If you ran these numbers now with the oil price being what it is today, none of the numbers would add up, even with 95% of North Sea oil revenue. All of the projections were hopelessly optimistic. Every year, the UK ratchets down over-optimistic projections on North Sea production. So it wouldn't have worked. Okay? Scotland is actually famous for producing the best salmon in the world. I quite like it. It's very good, smoked on a wood fire. And, that's what happened. Now, it was a little bit too close to call, right? I have to hand it to salmon. It wasn't smoked enough. It's underdone. And Britain should be ashamed of itself that they allowed the vote to get that close. Hopefully, some political reform and we won't have to go back and do this again. But it would be a disaster for the world economy, for Europe, for all of us if that union were broken. Okay? I'm not in favour of modern day politics and economics being tied to 300-year-old history. And we actually as a family can talk on that, because people forget the reason this vote swung was there are two sets of people in Scotland. There's the Scotland, the romantic Scotland of the Highlands and whiskey and golf and the Highlanders and kilts and all that nonsense. And there's the border people, the border clans, of which I come from one on my father's side. And the border clans were the ones that swung the vote. They never wanted to be not part of the union. They'd been wanting a union with England from the time it started. They were the clans, in fact, who got beaten up by the English the most. Every time the English crossed over and raped and pillaged Scotland, the first people to hit were the Scots, okay? Not the MacDougalls and the Campbells. And yet, 300 years ago, our family voted with their feet. Life was always better in England. The economy was always better. Scotland was always better together. The food was always better. The weather was better. Some argue the women are better. The men are definitely better. So, let's end of story, right? I'm hoping that doesn't go back to a vote again and stress out sterling in the UK financial sector, because British growth depends on it. So that's the good. The bad is we are back to a potential next 2 years of poisonous politics in the la-la land of Washington. This is what happened in the midterm Senate elections. As you know, the House of Representatives, which is a zoo at the best of times, has been under control of the Republican and unfortunately the sort of Tea Party influence worst got conservatism side of the Republican for the last couple of years. They've now won the Senate. Matching votes, so the Democrats lost 7, the Republicans gained 7, so that means they have both houses. Now this doesn't switch on till January, but for those of you doing your investment calendars from January to January, this is going to affect the US position, and it is going to mean a messy 2 years of nasty politics. How much is that going to affect investment and the performance of the S&P and the UK economy? I'm hoping not too much. A lot of it's going to be on foreign policy stuff. A lot of it will be on taxation, and that won't affect you too much. The US recovery is too entrenched now for it to be knocked back too much by the politics. The one area they can work together is trade, and that's good. That will actually be good for both American growth and global growth. And even some of the moves that are now the new unilateralist approach that Obama is taking will be good for growth and will be good for the economy and for the stock market. It would be a problem if Obama, who's been seen as a bit of a lame duck and been fighting this poisonous political everything he wants to do, they just say no and block it for the last 2 years, if he decided to just roll over and die. Luckily, this has actually been good for him. He's woken up and said, this is my last 2 years. He's switched into legacy mode from lame duck mode, and he's decided to test the limits of the executive powers of the US presidency. And you've seen a raft of stuff he's done since this crashing loss in the midterms. Climate deal with China, some stuff on internet broadband that normally you wouldn't get involved with, and a big thing with an executive order on immigration. And next slide, I love this one. For the Republican members in the audience, but just remind ourselves who this country is. Half of them are Scottish, for a start, and half of them are Irish, and the rest are Italians, and a mixture of everything else after that. So this is, you think about it, 4 million of a sort of grey area of labour who have been left in limbo land, but the US economy couldn't do without them. And the key areas of consumer rebound that I keep going on about, particularly manufacturing and building cars, okay? Construction, by the way, is virtually all Mexican. The guys actually banging those things together, because they're still building houses out of wood. All of that depends on these guys. But because they've left in limbo land, they save, they don't spend, because they never quite know whether they might be deported or not. So you're actually going to release a wave of certainty and security on 4 million lower-end consumers who've never really bothered consuming, right? As well as, of course, being good for American growth in general, because you finally get some stability to the floating labour force you need. So I think overall, a very good thing. Foreign policy, again, fairly calm, nothing to worry about too much in terms of investment and outlook. This was the APEC meeting of Obama meeting Xi. Just go back to that one, and it's all smiles. You know, he's sitting there thinking, you know, my navy's still bigger than yours, and we can still surround you and control the Pacific. And he's sitting there thinking, yes, but we own, you know, more treasuries than you do. You know, I think you must never forget, for all the rhetoric, for all the noise, for all the occasional buzzing by a Chinese aeroplane in international airspace of a US surveillance plane, because of course they're spying on each other, for all the noise about the South China Sea, China's best friend is the US in geopolitical terms. China's best export market is the US. China has more to lose than anybody else by the dollar going down and the US economy going down because they own most of the treasuries. And America's best friend is China. Who likes the Americans other than the Chinese? So this is actually all shadow play. They both have a national agenda and a domestic audience to play to, but actually they're all smiles, right? And he does look better in that Chinese jacket than President Jinping looks, right? If you look on the next page, the Japanese, that's the bit you've got to worry about. And the Chinese guys tell me, oh, we have a name for this, which tells you something about Chinese culture. It's called the bitter gourd face, which is written there in Chinese script. And he really does look like he's sucking on a lemon. And this is a problem, and it will continue to be a problem. I won't bore you with all the GDP details on now China is the world's second largest economy, but I did, for fun, do a quick calculation on my GDP market share of the world thing that I showed you a couple of years ago. And what's interesting is all the growth of China, because it's a pie, right, has to add up to 100%, has largely come from Japan. If you look at that pie, and you look to see the EU shift, there hasn't been a lot of EU shift, because there's the East Europe side of that. Okay? There hasn't been a lot of shift in ASEAN, which tells you something. They're not growing fast enough. Indonesia, Singapore, Thailand, etc., and the Middle East, but we're stable. So we're growing relatively, but not increasing share. The loss of share, Japan used to be 9% the last time I showed it to you, it's now 6%. You can't be a world power and have muscle unless your economy is strong enough. So there'll be increasing rattling of world markets every so often by China testing the limits of Japanese defense in the South China Sea and the oil areas. Right, next. The final thing on geopolitics is the Middle East, and of course that's important because of just general instability and oil. ISIS, Syria, Iraq, all the things that are going on there remain a problem. Now, I know a lot of people think that ISIS are just a bunch of jihadist, extreme, the loony fringe of radicalism. And they go around chopping people's heads off and drowning themselves in a sea of blood. Most of it fellow Sunni Muslims, right? So they'll blow themselves up, right? And that's an easy model to put them in. But actually, you know, you underestimate how strategically smart they are. I find that what they're doing, the model of what they're doing, is scarily smart. So if they are the loony left, you know, of radicals, they're very smart. Lunatic fringe. They have carefully picked their fights and the areas they moved into. So on the one hand, they move into Syria and Aleppo and all the stuff that the West and its notional allies are meant to be going after against President Assad. So you're damned if you do and damned if you don't. You're going against somebody who's meant to be your enemy, and they are forcing us to put them as reluctant allies, so you can't do anything. And all the areas they're going in the north of Iraq are Kurdish areas, knowing the Turks would rather die than support any incursion by the Americans, because they use the air bases in Turkey and NATO, to help Kurds. The Turks really want to keep the Kurds locked in. So these guys have nicely positioned it that you're making your enemy's enemy your friend, but then they're your enemy, right? i.e., you do nothing. So the situation remains unstable. I think they're strategically, fairly a lot cleverer than we give them credit for. This will carry on. This will lead to instability. Don't forget, the second largest producing member of OPEC after Saudi Arabia is Iraq. Right? That's the play. And they've been smart enough to get a lot on a source of revenue by controlling some of the key oil fields, who are pumping as much as they were before. So they can't be that stupid, because the facilities are still running. Next. Okay, so it's the Golden Turkey Awards, which we do every year. Sadly, this year it's an all-German affair, and this has always been a sort of jokey thing, but this year it's actually less of a joke. I'm actually incredibly upset with German economic policy, with the way Merkel and Schnabel, the finance minister, and the Deutsche Bundesbank are continuing to drive Europe down this ridiculous path when you have constrained demand and deleveraging private balance sheets and high private debt levels, of sitting looking at the patient in an ICU and shutting off their blood supply, right? So this austerity orthodoxy that they're insisting that the rest of Europe follow is sinking the second major growth engine in the world. Before, so long as they were just mucking up European growth, and we were comfortable in investment in Britain, in the US, sitting out here in Asia, it was okay because China rescued us for a couple of years by pumping up both fiscally and through monetary manipulation and through huge quantitative easing program. They basically accelerated the China engine to keep things balanced between the US, Britain and China. Unfortunately, we'll talk about what's happening with China. That no longer works, and so Europe becomes everybody's problem. And these two people become everybody's problem. I haven't put Schnabel up there, actually, but it should be up there. And for the first time, I actually, support the French on something. It's rare that, I won't go and bash the French like any good Brit. We've been doing that for 2,000 years. We know more about that than anybody else. I take exception to it when this other person up there, who I've never even heard of, Gunther Ossinger, right? He's only up there because he wrote an article in the Financial Times, which shocked me, which I read, which was a public call for blaming the whole EU malaise on the French and the failure of structural reforms in France and the Hollande government and everything the French are doing and sclerotic labour market and all sorts of other red tape bureaucracy, all of which we know the French economy has and has always had, pension reform and a whole load of other stuff, right? And I'd be the first to step up and defend the French against, it's all right for us to bash them, but the Germans shouldn't. And this unknown guy definitely shouldn't. So it turns out, and when I looked him up, he is the EU head of digital something or other, i.e. none of us have ever heard of him. He's actually a political puppy of Merkel. I purposely put a picture up there with his new girlfriend. He's good at picking up hot-looking girlfriends. She's 26, he's double the age. He's got her because his wife ran off with the head of Porsche, right? So, which is understandable, right? You're married to him, right? Which would you rather have? This plonker who knows nothing about economics or anything else, and the best he can get is head of digital something in the EU. Or this cool guy who says, look, you can drive any Porsche you want every day for the rest of your life. I'm with you. So, but it's worthwhile reading that letter. And I think if we have any French here, the response of the French government should be very, very simple. We know what the problem is. This is a failure of growth and consumption, not just, we've got to pay down our debt and stick to our fiscal compact, and we're over-indebted, and we've got to pay it all off in the next 3 years and get back to our 3% level. Growth has to be stimulated to get demand back on the consumer side, not just crimp government spending by having the governments pay down debt rather than stimulate growth. If Germany is going to offer, for every 1 billion of debt they want the French government to cut, to have their consumers add 1 billion of consumption, that's a fair trade. And that is the core of the issue, and that is what's not happening. German consumers are not consuming. They're not adding anything to global growth at the margin. All they're doing is exporting machine tools to China. Right? They've been hit by that this year, and then going around lecturing everybody else that they should be paying down debt. This is a consumption problem. It is not a debt problem. So that's the Turkey award. The last significant political thing that will be of interest to you as investors, because many of us are British Chamber, after all, many of us have positions in the UK markets, UK real estate, etc., is next year is the British elections. The most significant political event for you in terms of elections. Now we've had India, that's very important, over Indonesia, and America, of course, will be our party time in 2016. May is a light time for entertainment, so I'm looking forward to it. I have often been asked by various people, what do you think about this threatening rise of UKIP and the UKIP phenomenon, and this guy Nigel Farage? And many people have been surprised, because I usually have an opinion on most things, politics and economics, that I've kept very mum about the whole UKIP phenomenon. That's because I don't like to disparage people when I personally actually know them. I don't know him very well. I know him only in the sense that you would know somebody, when they're the year below you in school. Okay, this is 25, God knows how many years ago. Right, so he's a year younger than me. Right, I have aged better, I think. Notice I'm wearing the same suit. Right, there is a reason. Now I'm commenting on British elections. There's a reason I'm wearing a blue tie. Right, I mean, how can you elect anyone who wears a purple tie with rabbits on it and drinks that kind of beer? But all I remember of this guy, all I'll tell you is, he was a bit of a lad and a bit of a joker and a bit of an entertainer then. Not your typical, Dulwich college boy. Dulwich was the kind of school where you'd leave and go to a good university and go and run the Bank of England. Not go and leave at 18, having scraped through your A-levels and become a city-wide boy and trade commodities, which is what he went off to do, right? He was an entertainer then. I see that he's refined his entertainment ability, and he's still an entertainer now. There's a huge difference between encapsulating a lot of angst that we know is in the British population on unfettered EU immigration and a Romanian and Bulgarian on every street corner and EU membership and blah, 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 right? And the loss of, the way Britain used to be, right? It's not like that anymore. But that is not a viable model for running what should be Europe's largest economy. I'm hoping that if it keeps its current growth rates, it will get to its rightful place as Europe's largest economy. And it's certainly not anything to do with, sound economic policy or having anything to say on how you run, an economy and monetary and fiscal sense. I'm hoping that the current ruling coalition sort of wake up to just addressing the underlying message from disaffected voters, not the man and UKIP himself. We will see. But that is not a good path for the British economy if it's going to have messy coalition politics coming in from there. Right, so that's the fun bit, that's the politics, right? So fairly benign. Let's dig into the hardcore economics. And I'm afraid here, I hope you've had your coffees and stuff to keep you focused on some fairly gruesome numbers. The picture is not looking as good as it should be, largely because of EU policy in transport. So this is my favorite leading indicator from the OECD. I've been looking at this for many, many years. What I want you to do is just look at that last bit between September the 13th and September the 14th. And you can see that the blue line, which is the OECD, i.e. the rich world, has suddenly taken a tip down. But if you look at where the indicators were going from the recovery, September 11, 12, 13, and you just cut off that last year, you can see there was a clear trajectory that was going like that. They should have been continuing
to go upwards on a lower slope, roughly the slope of the light blue line between September 11 to September 13. Suddenly, it's gone jump. That's not going to happen at this stage in recovery. And can you see the one that's followed it down, or actually pushed it down, is the yellow line, which is the EU. And as a result, it's flattened the other two, which is the UK and the US. Okay? That doesn't look good. And that is not what should be happening at a stage when the deleveraging cycle for balance sheets of households is finally washing through, real wage growth for the first time in 3 years is coming through. You shouldn't look like that. HSBC does a very complicated momentum-based indicator, which I don't use very often, but I still quite like it. It's very technical, but you can see it is much more extreme on the movements, and the green circle shows it rapidly tipping down this year. Again, largely driven by EU momentum, EU indicators, EU consumption, EU investment. Okay? And my own, what I call my canary in the coal mine, right? As you know, if there's bad gas, they drop dead. Okay? And you are sitting in, I think, one of the best canaries in the coal mine. My leading indicator that is an entire economy, Singapore. Singapore is a call option on the global open trade economy, right? The marginal growth that goes beyond your baseline growth and recovery. And you can see nothing there to make you feel good about Singapore. Okay? And again, not where it should be at this stage in recovery. So it was okay for exports to be in funk in 11 and 12 while we were recovering. But by now, with the US system motoring and consumers getting out of bed, that number should be a lot higher. Industrial production, appalling. Investment spend, negative. Financial services, as usual, highly volatile all over the place. Right? Never got its complete mojo back from the go-go years. So all three sets of leading indicators do not look good. Now, some of you may remember years ago, if we look at overall growth, right? And I always use the IMF data because, as you know, I'm a great supporter of its consistency and its predictable ability at the IMF to always get their forecast directionally wrong, but directionally, off, direction in the right direction, but off by a predictable amount, and always wrong, always over-optimistic. And the latest overall growth for the world, right? If you look at that cycle, you'll see that my M cycle theory, look at 1982 to 90, a bit of a messy M cycle, 94 to 2000, a nicer one, 2002 to 2008. It looks like we're doing, and this by the way is because of monetary policy, where you easy money, inflate, everyone rushes in, asset growth, market growth, you go up, you cool things down a bit, you still have a bit of residual growth and good credit and leveraging, and eventually it collapses. It's, as you know, economics are cyclical because of the nature of human behavior with credit. Let's go back to that. It looks like we are tipping up, okay, on the last part of the M cycle before going down again. Now hang on a minute, that means that, whoa, the last 2-3 years are flattening out at 3% world growth. Not the good old days where we used to do 4% world growth. We've lost 1%. That was it, guys. That is it. You thought we were still recovering. No, you've been through recovery. It's almost over. You're into the last gasp of the next 2 years of the last of the good stuff, which is coming through in the US and the UK, right? And then by 2017, you're ready to, start deleveraging again and going down again. Largely because the whole growth model has been completely messed up by ridiculous austerity economic policy in the largest economic bloc in the world, the EU, right? Because if you collectively take it together, it's actually the biggest economy, not the US. That doesn't look good, right? So that is why a lot of economists are going around saying, hang on a minute, what's happened to growth? And will we ever grow again? And is it the new normal, which is Bill Gross's view? And is this, a short-term trend, or is this some fundamental structural shift in the world economy? Right. let's look at what's driven this, okay? And why I am coming across as so, upset with German policy, and the Germans in general, and why it's appropriate. I've got my Basel 40, John mentions the bottom, do you remember that episode? And we all, Bridget, I know, is an expansionist Keynesian at heart, okay? The red line is the US, okay? Quantitative easing, easy money, right? Tons of it. A printing press that would all lead to hyperinflation and we'd all collapse, according to the Germans. What's inflation rates now in the US? So low, you can't even mention, right? 0.5, bumping up to maybe 1%, right? 5 years after, the Germans keep saying, no, you're going to go into hyperinflation. And then each year we say, well, it hasn't happened yet. No, well, it's going to be next year, right? Well, it's going to be next year. We're 5 years in. And the UK has followed a similar pattern. For all its austerity economics, that's the light blue line. Britain had a dovish, anti-austerity, reflate the economy, super easy money, pump prime it somehow. And because they couldn't do it through the fiscal compact, or at least going under some of the austerity economics of the EU, even though they're not in the euro, they did it the same way that the Americans did it, through the central bank and quantitative easing. And they also did it through another very, very clever way. They could headline austerity in Britain, we are going to cut government debt. And then they work out, sometimes the British can be smart economically, not often, but sometimes, they work out British consumption patterns, like America, is very much driven by a household, it's called a wealth feeling, a wealth experience effect of housing equity. Anglo-Saxons tend to spend more because they're spendthrifts. When they feel richer in equity in their houses because they're all obsessed about having a house. It's a British American thing. Right? So they don't rent houses, they buy them, right? If you're German. So what they work out is, I know what we do. We can headline austerity, show the Office of Budget, Fiscal Responsibility, blah, 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 we're being good Europeans and screwing out debt. But not only do we pump prime through the central bank with quantitative easing and buying bonds, because Kearney is a dove, and that's why they put Kearney in. They didn't hire Kearney because they thought he was a great central banker, but they hired him because he was a dove to counteract the fiscal hawks. Right? We will boost the housing market, right? And they did a whole load of measures to get the housing market going again. Housing prices shot up, people start feeling rich, they go to Marks and Spencer's and they spend some of it on a credit card, but the fact is, I know it's there because look at my house price, right? And it's one of the reasons why one of my top tips for you guys was UK real estate, and I hope you bought into it. Okay, so the gap between the red line and the light blue line and the yellow line is absolutely phenomenal. And the yellow line is showing you the results of hawk-driven policy versus dove-driven policy like me. I am a card-carrying, Krugman, Keynesian, reflate the economy kind of guy, right? Now, while they were sunk in the mire of 2012-13 and China was still growing at 9%, that was okay. We could live with, German idiocy. But unfortunately, now China's slowing down. This has become a major problem. And this gap is going to be the biggest issue you're going to face as investors. It's going to cause a real problem for those of you that are investment advisors because we see no sign of German policy changing. Right? I hope none of you bought heavily into EU sort of standard stocks. You're meant to value buy if you did anything. It might actually now be a time to go and pick amongst the rubble in 6 months' time or so. But if you were exposed, you would have lost quite heavily this year because it's now come through in the markets. Next. Go back. That's my gratuitous excuse for Captain America for putting the picture of the hot chick in. Marvel's very clever. It's from a point of view of corporate strategy, I think one of the best company strategies in the last 4 or 5 years. Right? They buy Marvel for 4 billion. They've already made 8 billion just on the characters they've produced movies on. And it's just Iron Man and Thor and a few others. Right? They've still got another 15 characters to mine, according to my son. And and they've just started, and they've doubled their money already, right? And of course, what they do is in all their movies, they always put some hot chick in rubber or leather or a mixture of rubber and leather. Right? So the fathers go along with the kids. We enjoy the movie just as much, and of course, we double the spend because everything they want, the popcorn, we buy all that. So America is still on a roll because it's done everything right. But look at these numbers, right? For a start. I've never had a chart where all the arrows are green. Okay, I've put hot off the press. We always try to make this, ultra relevant and right up to the money for you every year, which takes a lot of work. So we got the latest Q-on-Q growth figures in the US just this morning, and it came in at 3.9, okay, which was above expectations. And last quarter was 4.6. So that 2.6 GDP growth for this year is going to end up by the end of the year being around 2.8. Absolutely. So this thing's on a roll. Look at consumer spend and retail spend. It's up there, but it's not super strong. Unemployment is the key driver. More people have jobs, but they're still not spending much. What does that tell you? Okay, they focus on the right metric, which is what the Fed focus on, getting people back to work. But obviously, real wage growth is still not there, which is why the recovery is there, but it's slow, right? But investment spend is up, corporate profits are up, manufacturing is up, confidence is up, and Fed fund rate is still at 0.2%. And there's not an inflation problem, right? So it showed for anybody who questions whether the Keynesian methodology works or not, QE has worked, right? And fiscal pump priming, the little bit that they got, the tiny bit they got worked, and the monetary easing, right, which is the main engine here, is definitely worked. Next. Key metric, retail sales. Okay, but not great. So this is a recovery, but this is not the kind of recovery you'd hope at this stage, which is why you're seeing a very low tip up in the M cycle. For those of you heavy in the Dow, and you should be if you've been following me for the last few years, this means that how much extra juice is there to run in this year's recovery? It's spotty. Some of the cheap stuff, like Walmart, Costco, going up well, but not super. Some of the middle-class stuff doing okay. Some of the middle-class stuff like JCPenney doing appallingly. Some of the high-end stuff, limited brands, the Victoria's Secret thing, doing okay. But none of these are sparkling figures. Right? The other major metric for me, as you know, housing is my core US metric. I always tell you, every day, wake up, look at US housing. Right? Go to bed, look at US housing. And as you can see, the recovery that we said would happen, we called the bottom right at the end of September 10, and it would slowly grow. It's been recovering ever since, but that's not a great recovery, okay? The long-run 50-year average of house sales is 56,000 a month, and we're still at 38,000. Right? The thing that's now starting to build up is construction. That's good, because that employs lots of low-end people, employs lots of Mexican immigrants who now have the right to stay. It gets people spending, again, in cement, paint and carpet, and that whole housing ecosystem that I'm so fond of, which is why I like housing, because there's a whole economic ecosystem around it. But the fact is that that is not a great recovery, and that is why those who think, oh, this American recovery means we're going to tighten sooner, and start seeing that, when does the Fed start raising rates? Well, hang on a minute, it's not looking that good yet. Next. Along with girls, of course, I've got to have some gratuitous pictures of cars in here. So I think last time I had the Catalina. So this is a hang on, we missed that. This is the 68 Pontiac Firebird. So I'm still a Pontiac fan. I still haven't worked out whether I'm going to take this to Sri Lanka or bring it to Singapore. Fabulous car when Pontiac was a great brand. So if we look at remember cars for the US, this is the ultimate discretionary expenditure. Unlike here, cars aren't super expensive, and when you can't afford to buy a house or move a house, you can, when you've got sufficient money and you've got everything you need in your house, you can buy a car. It is a critical metric, and as you can see, whilst people aren't yet buying houses, they are buying cars. Okay? And for the US car industry, that 16 million sales a year is a psychologically very important metric, right? We haven't been up to 16 million, which is what the US car industry, every year they'd always do, you fall out of bed, you do 16 million, and they used to, in boom times, do 18 million. It's a long time since we broke 16 million. It's not like it went up there and came back down again. That is a very, very good sign. And for those of you who've been long auto stocks, you would have done quite well if you got in early enough. I'm quite surprised that Chrysler doing particularly well. It shows a great turnaround because they were the weaker car manufacturer. So it's broad-based and across all manufacturers. So on the US story, what you're seeing is, well, there's great recovery, and they've done all the right things, and you're getting growth again, but it's fairly weak on consumption, fairly weak on retail sales, fairly weak on households. Are people, has there been wage growth? Are people recovering in being paid? Yes, they're back to work, but maybe they're not earning as much as they were before. And the sad fact of the matter is, at the low end, the bottom end of the pyramid, real wage growth has been negative. Okay? So that's why they're going to Walmart and Costco and not spending as much as they used to. And most of the growth has been at the high end. Okay? So the Dow's done well, investors have done well, the rich have done well, but the vast bulk of the population, this is a fairly one-sided recovery, which means it's a weak recovery, and there'll be some time to go before the Fed wants to tighten. Right, Europe. Okay, what to say? You remember I'm still a huge fan of the dead parrot skit, and I showed it a few years ago, and The Economist has sort of finally caught up on this for Germany and for the EU. But if you look at the next set of figures, I have never shown a page like this other than in the economic briefing I did at the end of 2009 when the world was falling apart. Okay? And it doesn't have to be like this. So I'm not going to go through the figures because they're too depressing, other than just to point out that even Germany, whilst Italy, Spain, look at the Spanish, that's the official unemployment rate of 24%. Youth unemployment in Spain is above a third. What does that mean for an entire generation of youth and, drugs and gangs and all that stuff, right? So all those unemployment figures everybody up to shocked on that basis. Notice they've taken interest rates down to basically zero. They couldn't actually put it at zero because Draghi would be admitting that we've got deflation. So they had to put it at just above zero, and they do things in fives, 0.05%. But that's a stunning indictment, and Germany itself is now finding that it's export-led, zero consumption, none of us are going to spend a dime, but we're going to export machine tools to the Chinese. What happens when the Chinese themselves start slowing down? Houston, you've got a problem. Look at the retail sales figure. Okay, that should be triple that. Unemployment rate should be half that. Okay, the inflation target is 2%. So they go on about the fiscal compact and the fiscal debt levels of, we've got to stick to our debt targets and it should be 3%. But they're forgetting that the most important target is your monetary target of 2% inflation. That's their official EU policy. Deflation is worse than inflation, right? Ask the Japanese. Because once people think that things will be worth less tomorrow than today, they'll say, well, why bother buying something? I'll wait till tomorrow because it will be cheaper. And you get into a vicious cycle that goes down. That is far worse than this German obsession that I think comes from distant memories of the Weimar Republic of hyperinflation and what it's going to do to the economy. So, that is your second engine. Nothing more to be said, right? But don't worry, it was always okay because we had this third engine that switched on and took over while German austerity policies were wrecking the EU, and that was China, right? And for a while it was good because Chinese growth was, 9%, okay? And we all thought, well, it's going to carry on being 9%, or it's China, or at least it will be 8% plus. The latest figures coming in, yes, of course, it's China. Everything still looks green and positive, and there is some good news. If you look at the consumer confidence, if you look at the retail sales, okay, if you look at the auto sales, there is definite evidence the Chinese are finally shifting to a consumer economy, and people are starting to spend in shops and turn themselves into a standard, more developed economy, not just investment spend by SOEs on factories for export goods versus consumption spend. But the overall trend is not as strong as it used to be, and we've got used to supernormal growth, and it's now starting to cool down, 7.3%, only just in to their official targets, right? They might just make 7.5% at the end of this year. So the question is, next page, is China slowing? And is that what is leading to this sudden slowing of global growth, where we know Europe is blown up, and we know that the Japan, which I haven't bothered putting in here, because what's the point, because you know where it is. Japan will always do 0 to 0.5 to 1 to 0 to 0.5 to 1 to 0 to 0.5 to 1 for as long as we're still alive. So that engine's been off for 20 years. And unfortunately, my conclusion is that this is a structural, fundamental slowdown in growth. All economists will tell you, you cannot grow at supernormal growth rates forever, even the Chinese, right? You can achieve that for periods of 10 years or 20 years, as Korea and Japan and Taiwan have proved. And being Chinese, they've managed to do it for 30 years, right? But at some point, you hit the limits of productivity growth, you hit the limits of huge inputs into the labor force growth, right? And as you know, I'm very, very keen on the impact of demographics on economics. I called the topping of Chinese growth a couple of years ago when I showed you a chart saying Chinese working population has now topped out and they've already hit the decline, and there's the danger that they will, as we said at the time, grow old before they grow rich, and the Chinese know that, which is why they're hot housing growth and not letting go of their growth targets these last few years. But what I put up here is, if this really is a slowdown, let's just go and look at what the consensus forecasts have been, which largely hang around the IMF the last few years. And you saw that when we were back in 2010 and China was saving the world and growing at 10%, the blue line, the IMF forecast was, well, we'll carry on growing at 9.5% for the next 3-4 years. And then by 2012, the white line, they notched that down a whole percent. Suddenly, oh, China will keep growing high, but it will be 9% or 8.5%, not 9.5%. Come 2013, oh, well, it'll keep growing very fast, but suddenly now it's going to be 8%, not 8.5 or 8.75%. And come 2014, now it's they'll still grow very fast, but it's 7% to slowing down to 6.5%. Okay, what does that tell you? The fact is that I still believe that demographics trumps most other metrics when you have economies like this that have hit the limit of how much infrastructure you can build, how many roads and railways you can build, how much productivity you can get from technology investment. At some point you have to step into, right, you've done the fast growth bit and you've built up stuff and done the catch-up economy, largely driven by huge amounts of fiscal expansion and an enormous pile of debt. Now you've got to turn into a normal, rich consumer economy like Singapore is busy making itself into right now, and that means, let's face it, 3% growth, okay, at this stage, okay? So for China, that means, 5 to 6% growth is really what it's going to do, and most of that domestic, most of that driven internally in shops where it should go. Next page. And what does that mean for trade? Okay. By the way, just go back to that dumpling picture. You see, that's wrong. When you eat dumplings, the whole point is don't break them. You shouldn't let the soup out, right? Okay. Xiaolongbao, it's all about keeping the soup in. So I love this stuff, but that's not how you do it. You're meant to put your spoon underneath it. That's the trick. So what does this mean for growth? Now this is a complex chart, but just bear with me. The red line is Chinese real GDP. Okay? Look at that consistent strength of 10 to 12, right? Before it starts slowing down. And the black line is world trade. And without boring you with a correlation coefficient, if you just follow it by eye, you can see that the global trade cycle is following the Chinese cycle, with a few differences here and there, but by and large, peak, peak, trough, trough, movement up, movement down, they're following. For the first time, the black line is not going in the same direction as the red line. The linkage between a huge move of the global trade economy and this whole thing about, globalization and the Thomas Friedman book, and what has driven a lot of our strong growth and cheap consumer items, and everything we go into a shop now and it's half the price in real terms it would have been, when we were kids, right? Consumer electronics and everything, we're just flooded with cheap goods. That has largely worked its way through the system. And the linkage between global trade is broken, and as a result, global trade is not growing the way it used to. The white line to the black line, it would always be a rough rule of fun for economists. Global trade grows double the white line, global GDP. If GDP is growing globally 4%, trade will be growing 8% without even looking at the data. But that's not happening anymore. Trade seems to be suffering from the end of the great hyper growth of China for 30 years, which helped drive down inflation and the price of consumer goods around the world, and we all benefited. And as that starts to cool down, world trade and the great globalizations cool down. But the problem is, you're all sitting in a call option on global trade, Singapore. That is what Singapore is. Okay, so if trade and the great globalization thing is going to go into a new normal of lower growth, because China's now domesticating itself and going to turn into America, a big internally driven economy where most people are going shopping in a Chinese-made auto to a Chinese shop and buying Chinese-made goods and Chinese clothes, right? And going back to a Chinese house built with Chinese labor, with Chinese construction and Chinese timber, Chinese carpets, Chinese paint, Chinese lights, Chinese everything, right? What does it mean? Okay, and you're sitting in Singapore, okay, which is why, unfortunately, I am bearish on Singapore. Sorry, but it's just secular, okay, it's structural. You're not a big enough consumer economy to have an internal consumption engine. You're a call option on global trade, and that's where that's going. Next. Right, so that's the core economics bit, and the heavyweight stuff over. I'll quickly spin through money, and then we'll just end up on one. Right, on money, not much to report. The doves are still in charge, thank God. The only good thing about Europe is Draghi's there. They got rid of Trichet, remember, before I went and shot him. So, he's still the only person who believes in doing the right thing, pump priming. But there's not much he can do. The limit of your arsenal as a central banker is you can use rates, okay? And if you're allowed, as they did in Britain and the US, quantitative easing, but they're not allowing him to do the quantitative easing. They let him talk about it. Notice he announces in the paper, we're going to do quantitative easing and buy bonds, right? And the markets immediately react, and everything, sentiment improves, and the European stock market improves. And your investment advisors say, oh, phew, right? And then it goes down again because he doesn't actually do it, because the Germans won't actually let him do any quantitative easing. So you're left with uber easy money, and that will remain for a long time. Next page. On employment, okay, the US employment picture, the key measure for the Fed, for its own very easy money, is now dead on track in recovery. Shows the benefit of their policies, and very close to where I said it should be in 7 years at 5%. It's almost exactly on the forecast line that we gave you 5 years ago. Okay? So that means that their core metric they're following would say, we can start letting our foot off the pedal soon and start letting rates rise. But remember, we showed you the recovery is still weak, and I still believe it's going to be lower for longer, and the tightening, okay, for those of you who are structuring bond portfolios or are investment advisors, I still think it won't happen until autumn of next year. I don't think it will be a summer event. I think the US will still be the one that does it first before the UK. But of course we are going to tighten, and it will come in slowly, and it will be 0.25%, 0.5% move, most probably 0.5% around September, October. The FOMC around September would be the time. It's not going to be a rush job. And then it will slowly step up after that. What are the markets saying? Let's look at the yield curves. Isn't this great news? For the first time, remember I showed you the yield curve each year, and they've always been shifting downwards that way, i.e. cheaper money over a longer time, i.e. less threat of inflation. Right? For the US, for the UK, right? We started with the white curve in 11, and it shifted all the way down to the yellow curve in 2030. Each year, longer-term money getting cheaper and cheaper. Britain and the US, for the first time, the curve has shifted back that way, signaling that people now think rates will be a little bit higher going 5 years out. So for the US, it's gone out to around 1.5% from, 1%. Okay, not much, but it started to shift out. EU still shifting the other way, right? i.e. in funk. So the markets are saying there will be some tightening, and it's coming, but it's not a lot, don't worry, and it's not going to be something that causes the whole thing to unravel and the markets to unravel. If I were an IFA, I would still bet on a calm return to normality in rates, not a sudden unraveling and a crash. Next. And of course, the benefit of all of this is going to be, and has been already, the dollar. And all I will say on that is, I would continue to make the call I made last year and the year before, which is, bet on the dollar. I'm betting on the dollar. I've just done a whole bunch of refinancing in it. I'm not hedging, so I considered it. It's going to cost me about 400 basis points for a protected hedge. And because I still think rates are going to be lower for longer, I'm not buying that. And remember, everything I tell you, I actually put my own money on in my own businesses and structure our finances accordingly. So I'm long US. I'm going without a hedge. I think that it will tick up by about 150 basis points in the next 2-3 years, the time frame I'm looking at. Hold the dollar, right? You can, if you want to do the other way and you like shorting and stuff, then of course you go euro. Next. So the last big issue for all of you is oil, right? So if I don't have good news on growth, the big question for all of you is, has growth, slowed? Is this a new normal? Where are we going? And is the best already behind us? And unfortunately, of course, the corollary of that is, if you're an investment advisor, that makes next year tough. Sorry. Because a lot of this recovery story on one engine, Captain America, is already baked into Captain America's share price. Right? You should have bought this stuff when I told you 2 years ago, and then you would have made 25%. If you're not in the market now, I wouldn't get in now. If you are in, and I was an IFA, I'd say hold, but this is not the time to try and go value picking in the US market. It may be the time if you have an extreme risk appetite to go value picking in burnt out, bombed out euro cyclicals, but that's a high risk strategy. But on oil, this is a sudden move that can have a big impact on a lot of us who are interested in investing in oil and a big impact on the world economy, because don't forget, oil price is a tax on consumers, right? It takes money out of their pocket, the second largest tax after government taxes. So if you have a prolonged period of cheap oil, you're going to boost consumption. You could boost consumption by as much as, GDP growth rates in the EU, UK, the major oil importers, the US, by 0.5% to 0.8%. Okay? Everything depends on this guy. If you don't know who this guy is, if you're an oil trader, you'll definitely know who this guy is, the most powerful man in the oil industry. Al-Naimi is basically the head of OPEC. He's the Saudi Arabian sort of oil head honcho. The marginal production in OPEC, the spare capacity that they can turn on literally like a tap, because funnily enough, it is a tap. You go to Saudi Arabia and it's a giant tap, and the oil just comes out, and you can just turn it on and turn it off. It is as simple and as frightening as that. And the only guy who could switch on up to 2 million barrels a day on or off, or at least 1.5, is this man, and Saudi Arabia. And the OPEC meeting tomorrow, okay, everything is going to depend on whether this guy says 30% decline in oil, we're going to stop this, and we're not going to go into a price war to preserve market share, right? And if we look at the data on the next page, you can see how finely balanced this is. Next page, please. So, Al-Naimi data. Next thing. he's playing a game of chicken, right? And what's happened, the reason why, as you can see, 2013 there was negative spare capacity, and suddenly we flipped into 500,000 barrels a day of spare capacity. And we all know that that figure's a lie, because that doesn't account for all the undeclared production that people are quietly sneaking out the door and not declaring it. And the oil that ISIS is stealing and selling in trucks across the Turkish border that leaks into the global oil market. Okay? But of course none of that happens, right? None of it leaks into Sri Lanka either. So, so there is about 1 million of extra capacity. And as Steve will tell you, why economists love oil price economics is it's the ultimate expression of marginal pricing. Okay, 90 million barrels consumption a day in the world, but the price is set on the last two, plus or minus two. Too short, the price can shoot up by 50%. Too over, the price can collapse by 50%. That's why economists love this stuff. Right? All high school economics students, that's what they should be taught. And this guy, okay, they've all got to balance their budgets, right? But Saudi Arabia only needs an $87 a barrel price to balance its budget, whereas Venezuela and Iran and Russia are screwed. Okay? Does the Saudis like Iran? No, the big power play is Saudi as the regional power versus Iran. They want to keep Iran in check. Do they like the Russians? No, because Russia's not part of OPEC, and they want to keep non-OPEC oil in check, knock them down, right? So, and you know, Venezuela, nobody cares, unfortunately. So these guys can live with a lower price because they've also got 400 million of reserves. Sorry, 400 billion of reserves, okay, sitting in their, you know, equivalent of 10%. Okay, they could happily live with $70 oil, okay, and make up the budget difference from their state reserves. Okay, so I think that what's actually going to happen is this guy is not going to blink. He's playing with fire because he's the only one who can't get burnt. Right? The other guys are going to get burnt. And what you might see happen is oil just go, okay, and equities go doom, right? Because that's immediately shifting money from oil producers into the pocket of consumers in importing countries, which is good news for the global consumer economy and bad news if you're an oil producer. Okay, and if you want to bet on that, of course there are interesting ways to play that game. And it could stay lower for longer than you think, right? Because this tight oil, i.e. shale oil, coming out of the US, was meant to floor up at about 6 million barrels of production a day, take the US from being a declining producer that was getting, you know, to 4, to take it back to 6, which was pretty good for the US. It now looks like the US is producing as much as 9 million barrels a day, and it's now one of the world's biggest producers. This is truly a revolution. And what the Saudis are also playing as, he thinks that if he brings the price down, the game of chicken is also, of course, mainly with the US, he'll preserve market share and take this high-cost shale production out of the market. Okay? But the Americans say, actually, we're getting more efficient with this shale stuff all the time, and we can happily continue to produce it at around $60 a barrel, 70. Yes, there's some expensive stuff where we need, you know, 80, 90, but there's some stuff where we're getting efficient enough to take it out lower. This is, therefore, game of chicken. The Americans won't blink, they're coming producing the stuff. The Saudis won't blink, they can live at a lower price. The people who will suffer, and you shouldn't be holding shares in the Russian market, are Russia. You haven't been listening here if you are. Venezuela, right? Iraq, and Iran, okay? So, and of course, every other non-OPEC producer. Nigeria is already something, okay? The other thing you need to know is when we used to show you spare capacity around the world in the oil market, and you might remember, I've updated this for a long, long time, the only number there that used to have a positive number, the green is positive, the red is the difference between the light grain, the heavy grain and the light grain. The only number that had a lot of spare production capacity was the Middle East, and that was basically Saudi Arabia. Now, you've got spare capacity in Russia, Kazakhstan, Norway, all of the Middle East, North Africa, Nigeria, Canada, Mexico, Venezuela. What does that tell you about the prognosis for, you know, the potential for oil to stay high. Okay? Next page. And again, Steve could tell you more about this than me. There's this thing called, unplanned outages, which is sort of shutdowns and loss of capacity in the world. This is just the non-OPEC countries. The OPEC countries are exactly the same. The important thing here is it's going down. Okay? The amount of loss of capacity from dodgy geopolitics going on in parts of the world like Sudan and Iraq have reduced massively. Next page. So, consumption, the Great Asian Consumption Story, which is the yellow bar, will continue to grow at about 500 million barrels a day, and you'll get the world total of 1 million barrels a day, each year growing. Next page. World oil production from North America is going to be clocking in at 1.5 to 1. Let's say it's knocked down to 1 because of this Al-Nami playing chicken and pushing the price down, but that's still enough to take out all of the marginal world demand before OPEC. Okay, this, and the Americans won't stop, and this is before the Chinese start shale oil production and everybody else starts shale oil. This means oil is going to go down. Okay, they will not cooperate in the OPEC meeting tomorrow and will do a deal to reduce production. Okay, so that's it for the economics. We always end up just saying, what did we recommend last year and how did it do? We said if you're in US equities, hold it. You would have made another 6%. Don't get in because I thought it was overvalued. We said to buy the UK, buy UK real estate, buy British companies. We said to go long on emerging markets in the second half of the year when they recovered from the wobbles caused by fear of tightening. Indonesia was one of our picks. You didn't hear me in the second half of the year where I was very bullish on Modi and wanted to buy India as well. We said short bonds. We said long US dollar, short most emerging market currencies. So all of that we got right. So hopefully you all made some money last year. The thing that we got wrong was we said, speculatively, and it was a speculative position, pick up value EU stocks that were burnt out and bombed out if you really wanted to. And of course, what happened was that has continued to go down. So they're even better value today. There's still a play if you want to, if your advisors are looking at you being aggressive and taking high-risk positions and wanting to take bombed-out cheap stocks. EU is, of course, again, but as an economist, I'm saying the EU is not going to improve for a while, but it may be you find value in the stocks. For this year, next page, you can see that, as I said, there wouldn't be that much more juice in the US, and there wasn't, because and I still believe it's fully overvalued. But our play on emerging markets in the second half of the year did very well, right? We were in Sri Lanka, Indonesia. India, of course, did the best after the Modi victory. So for those of you that followed me into my taste for frontier emerging market Asia, you would have done okay. If you remember last year, the year before, we said be US, and you would have done okay on that. Be short bonds, and the year before it was a US play. So by my maths, you should all be up by at least a third to 50% if you've been following what we say, depending on what your investment advisors have been saying. UK house prices, we said go long on that. I'm still very long on London prices. That's done very well, 28% this year. And last year, my frontier market top pick was Bangladesh. I'm about to open our first coffee bean and tea leaf in Bangladesh, for those of you who go to Dhaka. That will be open by February. And this year's, that was the slide I showed you last year, this is how Bangladesh is done. So I think there's still a lot of attraction for this restructuring growth economy. So where I am recommending you go for the medium term is basically South. Right? I'm a great believer in South Asia. It has consumption base. Sorry, okay. Yes, I know it's running fiscal deficits. Okay, the red stuff. And yes, some of it has a current account deficit, not a surplus. Okay? But these are consumer economies. They are not driven, unlike the other Brit nonsense of Brazil and Russia, which is a commodity-driven or oil-dependent nations with not great demographics. or China, which is now structurally challenged on its demographics and is slowing. The reason I bang on about going into South Asia is because you've got all the right ingredients of urbanizing, growing middle class, consumption economies, and extra juice on the table as they restructure and get in infrastructure and invest and all the things they need to do and liberalize. It can only get better, it can't get worse. And I'm okay on the fiscal deficits and the current accounts. I think they're managing that. They've got better central bankers, and they have a massive demographic advantage. I still like Indonesia, but I don't think it's as good a play as South Asia. So that's where my money is and our group's money is. Next page. And this is the forecast. You'll get all of this. So for those of you who want a copy of the numbers, that's my GDP forecast for these economies. I'm heavily into Sri Lanka and Bangladesh. Just India's just too big for me, so the best way is direct investments. But if you have to look at the market, it's still reasonable value. And I think the CPI will be reasonably under control. The big problem with South Asian economies is the inflation. They tend towards under-managing the monetary base and getting too heavy inflation, but that appears to be under control. Okay? To end, we always end on, taking the piss out of somebody. Enough about the Germans. I thought the whole banker foreign exchange thing was fairly, hilarious and shocking. You don't need me to tell you that we all know investment bankers and traders are scumbags, and they have these animal spirits and they behave like animals and they live to screw people, and if you're a numpty or a muppet or whatever language they use. I didn't put some of the more colourful stuff up there involved with the F word, but you know how these guys operate. What never ceases to amaze me with investors and investment advisors, some of them as well, is Asia still has a taste for playing the foreign exchange market speculatively. I can never understand why any of you would ever want to go and take, you and your investment advisor and, a few 100,000 here or even a few million here against the world's biggest, largest banks, run by a bunch of people who just want to fix and stiff the market, and you will always lose and they will always win, right? Why people play speculative trading for notional investment gain on Forex as a private investor, I've never understood. But if you needed proof of how the largest, most liquid and most controlled market in the world actually operates, you've seen it in the last few weeks. So, don't be tempted, stay out of this market, you're only going to be shafted, right? And these structured time deposits where they flip all the risk onto you. And I used to reverse engineer those, they make anywhere from sort of 800 basis points to, 1,000 basis points. And it's always geared so that you ultimately lose. Or you're making a game on a level of risk you have no idea what you're taking. Okay? So that's a good one. I like that. Okay. Next stop is US elections 2016. We all know what's going to happen, right? She's saying it's my turn. Stay off me. Bill is saying, I'll manage the interns. We'll have some raucous domestic politics for the next 2 years, but I think we'll still do okay in the US. Stay in if you're in next, and that's basically it. Any questions? And you will get. I know a lot of you say, "Can I get a copy of the slides and the data?" And la la la. Bridget will let you know how to download it off the website. For South Asia?
Well, for everything. Normally you're very specific about
yeah. I've this year given GDP forecasts on a very focused basis for South Asia because a a lot of IFAs and investors want to say, what are you investing in? What's your tip? And South Asian economies, all of those have a range, you see, of about 0.3, 0.4%, because they're economies that have a less tight set of consumer variables driving them. So there's usually a bigger range of growth. That said, none of those guys are going to grow less than 6%. And in a world that is where China is rapidly coming down to that level, they will be the fastest growth economies, and some of them will do 6.5%. On the world economy, I think next year, if we do more than 3.5%, that will be good showing. And if Europe does more than a percentage point, that will be a good show. I am still, as you heard, bullish on the US, and I still think that it can carry on at this kind of level of around 3.5%. But I haven't sort of put that down on a piece of paper as such. I can do that. The stuff I've committed to is my top investment tip on South Asia, and that needs a bit of flexibility.
South Asia's too exhausting. Just a
Yeah.
interest. I mean, others might be interested. It says, speaking at a conference in Jakarta yesterday, and it was opened by the Minister of Finance, and he was very impressive actually. I thought he really knew what he was talking about. And the whole conference was about how finally Indonesia was going to start to achieve its potential. Lots of speakers, including myself. And and the whole thing came to a grinding halt towards the end. And the deputy prime minister, the deputy president, because the president was off somewhere, so the deputy came, and he gave all the same old answers that I've been hearing for 30 years. Well, in the national interest, we have to block this, we have to block that, and everybody kind of, the whole mood went up, and then when he spoke, it just went
down.
It was like same old, nothing changes. So people are deeply depressed.
Yeah. And that is why, for me, Indonesia is not as good a bet. I know it very well. I worked for the Indonesian government for two administrations for 6 years in a row, and although I love Indonesia and Indonesians, my money is all in South Asia, not in Indonesia.
I have 2 or 3 comments. First, on South Asia, I start being a South Asian. I think one of the biggest impact on the economy is created by more the mood of the people, of the consumers. And I've seen a huge change in the past 6 months in that regard, with regards to, I think, at least the initial signals which have come out of the government are extremely positive, and I haven't seen those sort of statements or those sort of directions being given by any of the previous governments. So that's a very, I agree with your analysis here. Then a couple of other points that I'd like to make. One on the two growth engines that you mentioned. One being the EU. So EU, you mentioned that reducing the debt by the Germans and the other governments there is playing a spoiler game, and that's what is not helping the consumption-led economy, led growth. It's the same market which a couple of years ago were punishing the bond markets there, that the government debt is extremely high, and that had other extreme consequences, and that's probably the reason why the governments turned their table and they said, okay, we have to cut down the debt. So I don't know how to read this. The other part, as a student of economics, I have been learning that more money supply will lead to more inflation. Now, yes, that has not happened in the US, but to me, there could be 2 reasons which I can attribute. One, is it more a factor of luck and more a factor of technology because of all the oil coming out of the shale gas technology and all? And secondly, are we reading it right? I.e., with all the growth that is happening, is it more the supply of money that is going? Is it going more to the top end of the society? And rather than it leading to inflation, what it has led is more hoarding of money, right? And that's the reason that we are not seeing the impact of inflation. So these are
Okay, good economic questions. On the first one, the EU, look, it is absolutely correct that you have to establish confidence in your debt, in bonds. Otherwise, you have a debt crisis. And it's good I actually I've been doing this for 10 years and showed you the slide in 2005, while I was railing against excessive amounts of debt in both government and household balance sheets, and saying this can't go on, we'll get into trouble and you have a debt crisis. And of course you don't want to do that, and you do want to establish the authority and confidence in a nation's debt that you are bringing it down. And it's under control, and people will buy your debt and keep yields low enough, and you don't have a debt crisis. All that's correct. But suppose, they didn't listen to guys like me then, and they carried on building up debt, and then they investing in all sorts of silly housing stuff, and then it collapsed, right? It's the equivalent. Once I was 18 and young and reckless and had some girl in my car, and I used to enjoy skidding around corners and driving too fast. And my mother used to say, look, you've got to slow down, you will have an accident one day, right? Which is correct, the debt story. But I didn't. And one day I smashed into a bridge and wrote off the car, and luckily we were okay? But I had to go to the hospital for a bit. So suppose that was a bit more extreme and I'm lying in intensive care. Is that the time to go eat and say, look, you should listen and you shouldn't be doing that, and you're not getting a blood transfusion, right? There is a time to be cautious on improper use of debt and a build-up on the balance sheet, and there is a time where you have to reflate demand where demand has collapsed. And in a situation where an economy is comprised of the state side and the private side, if one sector totally collapses, in this case the private sector and household balance sheets, and corporate balance sheets and the banking side, which is the intermediary, also collapses, if you're going to take out the third engine, the government side, you've got nothing left. You can't ever grow back up to however much you manage your debt potential crisis and bring interest rates down. You can never pay it back because you have no growth. It's a balance between fiscal responsibility and growth that drives an economy forward. There is a time to open the taps, let debt flow, right, and get demand back again, and repair the banks and help consumers, and then go and pay down the debt. Otherwise, Japan, which has 200% of its GDP in government debt, the highest in the world, would have had a huge debt crisis and collapsed, but it hasn't. Okay? So that's basically the Keynesian argument. It's not to say that you let people be profligate and you're not going to pay this down and restore national fiscal order. It's just you don't do it today when the guy's still bleeding on the street. You patch him up and wait till he's back walking and out of hospital and at least in the daycare ward. And then in the daycare ward you can start saying, right, time to start paying your bills a minute, right? Starting with a hospital bill. On the inflationary thing, again, this has been a great economic experiment. Classical economics teach you that you flood the place with money, inflation will go. But practice says that is not the case. You have to remember the rest of your economics, which is that money has to circulate. Okay? But if no one's got a job, and everyone is deleveraging, and everyone's depressed, and everyone is saving, not spending, okay? and half the spenders are just not even there, and the banks are deleveraging and reducing their balance sheets and their capital, okay? The money doesn't circulate, so it doesn't cause inflation. And we proved it in two systems now for 6 years. The proof of the pudding is there, which is Bernanke's great paper that you drop money by helicopter on the thing, where demand is so depressed it will not cause inflation. But then you watch like a hawk when it starts picking up again, so that you nip the inflation before all that flood of money starts leading to inflation. And at this stage, we still have too many consumers down and out, still too poor, no real wage growth, not back in jobs. That 5.9% employment figure, that's not the real employment figure. The real unemployment figure is still double that. Because, as you know, it's manipulated. It doesn't count people who've been out of work for a long time, school leavers who've never worked, so they're not counted in the employment data, blah, blah, blah. So the economics still works if the money is not circulating. Where the money has been circulating is if you took the growth in the Fed balance sheet, all that money that they've been flooding the market with, and the QE, and take the Dow, the S&P, okay, and put those on top of each other, you'll see a one-for-one movement, as well as a lot of the stock markets and other places, which is why, unfortunately, asset values are overinflated relative to the underlying economics, which means that if you are an investor or an investment advisor, you have a problem because the economics I presented to you and the underlying asset value in the stock markets don't match. Okay? They're overinflated, and a lot of easy money has gone into markets. And now that easy money tap is being turned off, markets, I think, are a lot risky as a result. It's not going to rush back and cause inflation for a while because growth is not strong enough yet, because it's still running on one engine. But it does mean that markets may well have a crisis, which doesn't affect the economy and economists, but it does affect investors and investment advisors. And I think you'll see a lot more volatile markets next year, which is why I apologise at the beginning and said, I'm sorry, mates, but if you're IFAs and stuff, you're going to have a tougher year. Well, let's put it the other way. You will be worth the money that your customers pay you because you'll need to think long and hard about what advice to give people because it's going to be a tough year. Because the risk isn't built into the markets, asset prices. And by the way, that's not just stock markets, art prices. Some could argue London house prices. All sorts of asset markets have a high degree of potential risk built in from all this free money. And remember, central bankers and economists, we don't care if you guys, if asset prices blow up or there's some high volatility. That is not meant to be the concern of the central bank or the economists. It's only a concern to investors.
Rowan, can I just use a football analogy, just cover some of the points made on the EU? There'll be Premier League football managers who would have heard from the terraces chants of you don't know what you're doing. Just what you said about the EU, is that something that the EU constituents would say about them? Is the EU in denial? And what impact is that the impact on Asia's growth?
Right, the Germans are definitely, well, firstly, the Germans are in denial. And the problem is that nobody else really has a voice. They control them. That's the problem. The French fully understand this, the Italians, the Spanish, and they're all railing against the Germans to lighten up on their fiscal compact and say, look, it's not that we don't want to get to 3% government debt. Of course that's sensible. And of course we don't want a debt crisis of people losing confidence in our debt. But they're not going to lose confidence in our debt right now. They're far more likely to have a problem if we go into deflation and spin out down a cycle of no growth. Lighten up for just another 2 or 3 years, and instead of having it 2015 or 16, let's have it 2017. That's all they're saying. So the French, the Spanish, the Italian, everybody else is saying, but they can't get past German intransigence. Secondly, funnily enough, the German public have been taught to put fiscal propriety first, and the Germans tend to be all about being conservative and not running up debt and squaring their balance sheet. So the Germans argue that the German people support this policy, maybe because they've been so well taught by their leaders that they think it's the right thing to do. The Americans, just the other day, the American US Treasury Secretary, Jack Lew, had a screeching, sort of thing, including putting it out into the media, railing against the Germans to lighten up and that this was not the way to go. And I think, as he put it, all of us can ill afford a Europe that is not going to grow and is going nowhere and clings to this austerity mandate. So everybody else gets it. Everybody else gets it. Everybody else is speaking out against it. The Chinese have been reflating their economy for years. The Japanese are doing the same. So it is an isolated thing of this German intransigence. They claim that the German public support it. Maybe they do. I don't know the German voting public well enough. But the problem is those guys are the ones that control the ECB. and the European Parliament and the European Commission.
Does it strengthen Cameron's arm to reform the EC, or do you think that's a...
Well, I don't think he can reform. Britain isn't powerful enough to reform the EU from the inside. So it has a stark choice. They either go along with it, but stay out of the euro, and continue to show that was a smart move, or they exit, which is what Nigel Farage is saying. I think they will, in the long run, see that they're best with the EU than without. But it does, partly accidentally, show that Britain happened to end up in the absolute best place it could be in the EU, with all the trading advantages, okay, but not in the euro. And I don't think it was done explicitly by design, knowing that the EU would go down this path, but Britain is in a sweet place. You've got all the benefits, but you don't have that currency, which means you don't have German fiscal rules. You've got the pound. You can later devalue, build up some debt, doesn't matter, not in the euro. Which is why for Europe, if you're going to make a bet on Europe, make a bet on Britain. Britain's the place to be. I think Britain should be the largest economy in Europe, by my calculations, by 2017, 2018, if it carries on doing the right thing. And hold sterling, right? Sterling's weakening is temporary, and it will continue to do well. Dollar will do better.
Actually, that's a good point. You said it's going to be the biggest in Europe. I mean, clearly the financial industry is the biggest in Europe and probably the world, up in New York. But based on what? I mean, I know we're doing a lot of things right, but surely once the Germans turn it around and eventually learn the lesson they should have learned, things would change.
Yes, but the problem is, that's the whole point, is we're looking here at, 5-year time frame at most, right? For economics, you can't do, it's another time beyond 5 years. And at this current rate, with the current policies in Europe, in 5 years' time, by the time Britain is big, you will have gone nowhere. Because it doesn't matter how much is tilted towards financial services and how much the German economy is tilted towards exports. These are mature economies. They depend on one thing, consumers. Consumers depend on one thing, having money to spend. That depends on one thing, real wage growth. That also depends on another major thing, you've got to have a job, okay, to have some wages, to start having some real wage growth, to go and spend it in a shop and in your house. And if you look at German consumption patterns, right, they're only the biggest economy because they've got the largest number of people at the moment. And they're dependent on this export-driven Japanese model. That is slow for structural reasons because of China. Go look at their pattern of trade and see the rest of their trade goes to the EU. And the EU is in funk. Right? So they have a problem. All these economies, the only thing that counts in the end is services and consumers. Whatever they do on all the sexy stuff on exports, machine tools, financial services, treasury traders screwing the FX market, that's 15, maximum 20% of the economy. 70% of the economy is people like you going shopping. And more Britons will be going shopping with more money in their pocket. Not as much as they should have. They still, real wage growth in Britain still hasn't reached where we were before we collapsed. In America, they're about 8% ahead. But it's better than in Germany or in France or in Italy, where it's still deeply negative, and a third of their youth don't have a job. They'll never go to a shop. They live on benefits.
One more question. The chart on China was quite fascinating in terms of the growth is now down to 7%.
It's coming in, they'll manipulate it up to 7.5% this year because they have to, because the target of the People's Republic, whatever they call it.
So the numbers are fluffy, but I mean, there is a problem. It's massive property market bubble.
And the property market bubble is correct. It has bust, and they have overinvested, and there is too much capacity in everything, and all those things about the looming China crisis you hear about is all correct. But it won't be a crisis because they keep managing a soft landing. Okay? But they will slide gently. Next year, for the first time you hear, well, we have to grow at 7.5% down to 7%. then they'll kill themselves and do whatever it takes to make sure they hit that 7% target for the next year and the year after. And then in 2017 they'll say, hey, guess what, our official growth target is now 6.5%. Okay, and then they'll make damn sure they make them, even if it means printing lots of money. And then you'll see this slowly going down to a normal run rate that would be, at this stage of growth, about 6%, which, hey presto, is what India, Bangladesh, Sri Lanka, Indonesia, Cambodia, Thailand, if it was run properly, but it's not at the moment. All those guys are doing. So then why be in China? You can be in all of those guys with a better balanced economy, with more consumption, less export. So I'm afraid the China slowdown is here to stay, for those of you that are long China, which is why I go long South, Indian subcontinent.
Okay, I think if we sat down any longer, we'd have even more questions, but I think Roman will be available outside. So there's some food and drinks outside waiting for us, and so just before we go, let's just say one more time, thanks to Roman.